What's going on, everybody? Welcome back to my YouTube channel. So for today's lesson, I'm going to be going over 3 entry strategies that you can use as a price action trader. So without further ado, let's roll the intro. Okay, so just want to let you know, towards the end of this video, I'm going to be sharing with you a keyword, and whoever puts that keyword in the comments within the first hour will be able to join our daily setups Zoom session that we do each morning from 7 a.m. till 8 a.m. UK time before London Open. And I will send you a link personally and pick one person to join each day this week. So make sure you stick around. So what is the first pattern that we're going to be looking at today? One of the 3 patterns that we're going to be taking a look at today is what I call the perfect breakout retest. So what does it look like? Well, we have a trending market that's pushing to the downside and eventually takes out a structural low, or if we're to invert this chart, you will see here a structural high. Now, what is this market structure indicating to us? Well, it's clearly indicating a trend to the downside with a pullback or an exhaustion and a continuation indicating bearish or bullish pressure. Now, what we suspect the market to do as part of theory and what price action does on a daily basis is once it breaks structure or a key level in the market and makes new lows, more often than not, price will respect this level in the future. Now, does it need to respect it? Not necessarily. And does it mean that if price starts to break above this level that we're now not sell bias, or should I say buy bias? Well, no, not really. But what we're going to do today is keep it very, very simple. And for our first pattern, we're going to be identifying trending markets that create lower lows and lower highs, or higher highs and higher lows, and then we're going to be looking for the market to come back to these levels for a continuation to the downside. So this pattern right here, I really want you to focus on, is classified as a perfect break and retest. So let's head to the charts and we're going to take a look at pound USD. So for our first example, what we want to identify with this market structure is price showing a strong indication of bullish or bearish sentiment. So if we start at the left, we can clearly see here that the market was creating a consolidation. Okay, it's sideways moving market. It's not making any higher highs and it's not making any lower lows. Now, how do we identify this? Well, look, you need to look at the charts from like a 12-year-old's perspective. And there's 3 questions you have to ask yourself. Is the market moving up? Is the market moving down? And is the market moving sideways? Once you identify one of those 3 patterns or criteria or structures, then you have a plan. So once the market is sitting in a consolidation area, there is no trades. What we're looking for the market to do is push strong to the upside, or if it was to go to the downside, push strong to the downside. Once you have that evidence, now you can start to gather that price is potentially going to continue pushing to the upside, creating higher highs and higher lows, and as we all know it, as a trend to the upside. Now, once price breaks a structural high, which in this instance is this structural here, we now know that this bullish pressure is significant in this market. What we want to see this market do, based on structure, is push to the upside, pull back or exhaust before a continuation. Because it's very rare that you're going to see the market just do this. The phases of the market is push, exhaust, and then push, exhaust, push, exhaust. So if we know that's the formation of the market and how it moves on a daily basis, once price takes out a structural high, what are we looking for the market to do? Well, we're looking for the market to come back to this key level. Now, I just want to make a point, right? Because some of you will be like, well, what if it doesn't come back? Well, the answer to that question is, if it doesn't come back, it doesn't come back. You just don't trade. You don't put anything on the line. You don't risk anything, and you just wait for a new opportunity that presents itself, right? Pretty simple, by my books. Now, what happens if the market doesn't come back fully and you have a level in the market where price creates a wick like this and you can't get an entry because there's no pin bars or engulfing candles? Well, here's the thing. What you have to decide is if you're taking a lot of trades and you see that the market is coming back to your key levels often and you're not getting the evidence or the confirmation you need, i.e. pin bars or engulfing candles or indecision candles, then you need to consider maybe it might be best, based on my circumstances and how I trade and my daily routine and schedule, to use limit orders. So in this instance, let's say we identify this as a key level, price leaves it and comes back. What you can do is set a limit order. Now, I personally like to give my limit orders a little bit of room to breathe, or buffer as it were. And I like to say to myself, well, if my plan is to enter here with a limit order, why don't I just move this up maybe 1 or 2 pips, and then I won't miss entering the trade. And all I have to do is just, let's say I was using an 18 pip stop loss. Because I've added 2 pips to the limit order, what I can just do is just add 2 more pips to my stop loss. And that just gives me a little wiggle room to make sure that if the market does push a little deeper into my entry, I still have that buffer at the end of it to cover what could be a potential stop loss if the market was to come back down and create some wicks. So that's the first plan. Now, how do I know this is the right trading opportunity or plan at this moment in time? Well, you want honest truth? I don't know. But what I do know is, based on my experience, if I take 10 trades and out of those 10 trades, 8 of them come back to my key level and just fly away, then in theory, a logical person would know that it's probably best to use limit orders. But if you're the type of person that you find price comes crashing into your key levels and then price decides to maybe break out and break back in, then you're probably best waiting for that to develop first and then enter either with an instant execution or potentially a stop order. So it's down to you. I will share the theory and I will share what I believe works for me personally, and then you then have to go and decide and figure out for yourself what works for you. Let's take a look at another example. So we can see here we have this structure in the market. Price created a high, remember? What we want to do is take that high and we just simply want to drag it to the left. Now, again, if price doesn't come back, it doesn't come back. And if it does, it does. All well and good. But what we're seeing now is a trend to the upside with a retest, higher low formation, higher high formation. Again, we only suspect that the market will pull back to make a new higher low before continuation to the upside. So with this evidence, what can you do? Well, here we have an example of a breakout and a break back in, and then price coming back to this level. How could you enter this? Well, our first one was a sell limit. This one could either be an instant execution with a stop loss below this structure, or even better still, you can do a buy stop with a stop loss below this structure. Either way, they both work. You can see price is sitting at this level. You can see that price is holding this level, and you can see that price is clearly showing strong signs that the market is more likely to go up than it is to go down. So an instant execution with an engulfing candle or a pin bar is completely fine. Or if you want more assurance that the momentum is still in your favor and the trend is still going to go up, then guess what you can do? You can use a buy stop or a stop order, whether it be a buy or a sell. Okay, now I'm not going to continue to highlight too much of this, but these are just 2 examples of what you can do or what you can achieve with this perfect break and retest strategy. Now, it happens all of the time, and as you'll continue to see, and as I highlight them here, we have another break of the structural high. We have another retest here, potential limit order for those that want to go for limits. We have another one here for those that want to go for engulfing candles or potentially stop orders. We have another one here where you can see price is breaking back into structure, coming back into structure, creating a retest, entry here, a stop loss here, a re-entry here. It really doesn't matter. And then we have another one where price is taking out some of these structural lows, and then you could be looking for some retests in and around this level. Okay, now I just want to make a point. Not every trade will win, and this is just a disclaimer. What I'm teaching you now is of my own opinion and how I personally like to trade the markets. It may work for some and it may not work for others. So just be very wary of this, okay? Now this is the 30-minute time frame. This also can be applied to the hourly time frame, and all you have to simply do is use the hourly key levels to identify how price is reacting, and you place your levels at the low or high of the bodies. And what you want to do is account for as many wicks as you can within reason, because remember, this is an area in the market. So what could be kind of noisy or messy on the 30-minute time frame in terms of this break and retest, you can see here how we can gather this information in a more clearer way. So look at the retest here, limit order here, retest here, breakout, break back in, indecision, pin bar, doji, whatever you want to call it here, break below the structural low, retest, maybe a stop loss, but a re-entry, and I hope you get the point. So let's move on to pattern number 2. So pattern number 2 is what I personally like to call a breakout of a consolidation and a retest. Now, this happens often in the markets, and what you will find is that the markets will not always trend. You'll have sideways moving markets where price decides to trap itself within an area. Whatever the reasons are for this, there's so many theories behind it. But what we want to see the market do is eventually break structure, come back to structure to retest, or potentially make lower high and lower low formations. So this is the second pattern that we're going to be looking at today. And I like to call this pattern the breakout continuation retest. So let's take a look at this. We're on USD CAD now on the 4H time frame. Now, why am I on the 4H time frame? Well, you'll find that a lot of the structure is built from high time frames. So if we're going to be looking for a true directional bias, then what we want to be making sure that we're doing, especially for higher time frame traders, is identifying what the market is doing. So if we start from the left again in and around this area and we mark out what the market is doing in terms of highs and lows. So I like to take the highs, join the dots, find the lows and join the dots. Now, if we take this information, what we can clearly see here is that in and around this level, the market has been moving sideways for a very long period of time. No real higher highs or higher lows have been made. And eventually we have a break of this structure, and look what we see the market doing, coming back to this level as a retest. Now, I just again want to make a very clear point. Not every single time will the market come back to retest these levels. And sometimes the market will break back into these levels and then you'll find a continuation to the downside. Now, it depends on your strategy and how you decide to trade this. You can look for engulfing candles, indecision candles, potential pin bars. You can use limit orders, stop orders, or instant executions. Once you find these areas in the market, this is where you want to trade, because there's a strong behavioral pattern here that if price was trapped and eventually we have this break of this structure, then what you can identify is that after a break of a structure, the normal phases, which is a pullback, will occur. And if price respects the lows or the highs of that breakout, then there's a strong chance that that's just a correction or a pullback or exhaustion, whatever you want to call it, before the market then continues its descent or ascent in either or direction. Again, we can see this market didn't really continue down, but understand this is a 4H time frame. So the market is not just going to plummet to the downside or plummet to the upside. It will make a series of higher highs and higher lows and lower highs. So just be wary of that. If an opportunity doesn't present itself there as perfectly or as efficiently as you want, then just wait for the new one. Here we have our structural high. What we're going to mark here is our structural high. Join the dots, find our lows, join the dots, and pull it to the side. Now, what pattern do we have here? Well, we have a beautiful breakout of this structure. We have a break back in, another breakout, and look at the retest. So another pattern that you can identify yourself in terms of these consolidations and sideways moving markets, and look for these breakout and break back in retest. How could you trade these? Again, limit orders, sell stops, buy stops, or instant executions with pin bars, engulfing candles, or whatever you prefer to do. Now, just because we're looking for this retest, it doesn't necessarily mean that you have to wait for the retest. You can take a series of lower highs or higher lows on the way down or on the way up. It really depends, but if you're a trend trader, that's in theory what you should be doing. A final example that we have here on USD CAD is our structural high, respecting our structural low, and then a consolidation in the market. Now, how do you identify consolidation? Well, look, it's pretty simple. As I said, you want to look at the charts from a perspective of a 12-year-old. If the market is moving sideways, you will see it's moving sideways. Even if the overall trend is to the downside, you still need to identify where the key levels are in that downtrend. And how do you identify those key levels? Well, you're just simply looking for price to show that it's not making any highs and price is failing to break those highs. Once you get that information, what you're then looking for the market to do is eventually break out of this structure to show a strong sign of bearish sentiment in this downtrend, and then looking for the market to come back to retest this level. Once again, if you get the evidence and the confirmation you need to take this trade, then guess what? Go guns blazing and get in the market. So that's our second pattern that we took a look at today, which is the breakout continuation retest. And the final one that I'm going to take a look at for you is what I like to call, and in my personal opinion, my favorite pattern, is the continuation double top or double bottom pattern. So we're going to take a look at the 1 minute time frame to do this, because I really like the 1 minute time frame. And what we're going to be looking for the market to do is create a lower high or a higher low in a downtrend or an uptrend, and then just simply create a retest of a new form lower high or a new form higher low. What do I mean by that? Well, here we have a lower high formation, and now we have a retest of that lower high formation. If I flip the charts, here you can see a higher low formed and a retest of that higher low. So let's take a look at Euro JPY on the 1 minute time frame. Now, again, the whole consensus of what you're learning in terms of these free entry strategies is that we're taking all of these trades as part of continuations. So let's continue to identify, using the same theories that we were previously, as perfect break and retest areas in the market and consolidations. Starting from this level here, we can see that the market was pushing to the downside. We take the structural highs, structural lows, and look what we see here. The market is sitting in a sideways moving market. What we're looking for the market to do is break out of that structure with continued pressure, either to the upside or downside. Now we're looking for the market to pull back and retest the structure. Now, personally, and from my experience, and I'll share this with you after backtesting a lot of data and gathering that data and crunching the numbers, that double bottoms and double tops on the 1 minute time frame work very well. So what we want to do is take the first concept, is identifying a level created in the market, and we just want to move that to the left. And as you can see here, we have evidence of this bullish pressure, a level created, and the level being respected. In this instance, you can look to take a trading opportunity with bullish engulfing candles, stop orders. I personally would not use limit orders on the 1 minute time frame, but that's down to you to back test and then take those trades. And what this does is this confirms to you a strong sentiment in the market. In this case, bullish sentiment, that a level was created, a respect of that level, and then a stop order or a bullish engulfing or a pin bar illustrating bearish pressure, depletion in that bearish pressure, going back to a bullish sentiment, and then looking for that continuation. We'll continue to look at these examples, and as you can see here, we have price taking out these highs, taking out these highs, and what do we have? Well, we have a push phase in the market, price pulling back to create a level, and then coming back to that level and respecting that level. Here again, how could you take this trade? Well, with a buy stop, bullish engulfings, pin bars, whatever it may be that you want to go for with this trade is entirely up to you. I personally like to use stop orders when it comes to the 1 minute time frame, and then you can set your trade and go for your targets, your 1 to 3 risk to reward ratios, whatever it is that you're looking for. And personally, I really like this because we have a level that's created that we're not impulsively jumping into straight away. We're identifying that the market is creating that level and then respecting that level. Now, what is the key word? As I mentioned, whoever comments in the next or the first 1 hour will be able to join our daily setup Zoom session that we do every morning from 7 till 8 a.m. just before London Open. The key word right now is break and retest. Comment below and I'll pick one person a day to join, and I'll send you the link to Zoom, and we'll start from tomorrow. So anyway, these are the 3 patterns. Just to recap them for you, we have the perfect break and retest pattern where price comes back to a key level in the market, shows strong signs of rejection, bullish, bearish engulfing candles, indecisions used in sell stops, buy stops, limits, or instant executions. The next pattern that we took a look at was the consolidation or the breakout continuation pattern, where price is trapped in an area with no clear signs of a directional bias, and we're looking for the break of that structure, a retest of previous structure, and then a continuation to the upside. And then our final pattern we took a look at was the continuation double top or double bottom pattern, where the market creates a level, comes back to respect that level, and then continuation, and then you get that continuation to the downside. So I hope this was useful, and if it was, make sure you smash that like button, subscribe if you haven't, turn on notifications, and don't forget to comment below. Break and retest is the key word, and you can join our Zoom session all next week. One person a day will be selected. Take care for now.